Hello, everyone, and welcome to the Dream Builders Insurance Podcast. We're so grateful you're watching today. I'm Carissa, and and we have a guest with us today. You want to introduce yourself?
Dustin Wylie from Oklahoma. Been in insurance for a little over a year. Glad to be on.
Why do you think your lovely beard that we can't grow attracts people to you?
I've had clients tell me that they trust Gandalf, and I look like Gandalf. But then I've also heard, you look like a dad, you talk like a dad, you just seem like someone who's trustworthy, that I can just talk to and you're not going to try to sell me something. So I think that's really about it. They just say that I present myself as not a salesman.
Yeah, I think that that's a beautiful thing, because even kind of like for both of us, we're not really, our approach is definitely not salesy, and we look like people that you want to talk to. So
right.
That was your fun fact for you. Okay.
That's right. So, Dustin, can you tell us now you said you've been doing this for a while. How long, how did you get started in the insurance industry?
2021. I had 6 months left in college. I was about to get my bachelor in business administration. And I really just looked up and I said, hey, the average salary in my state is $36,000 a year. And I don't really like what I went to school for. So what am I doing? So basically, this might be kind of brutish, but I started like a program called 75 Hard. And I decided, hey, I'm going to do the hardest thing I could possibly do for the next 75 days. I'm going to start a new business. I actually had a business going. It was a sewer camera business. And of course, anything about sewer, it's not fun. It's messy, it smells. And I was just like, I've had a couple of heat strokes. I'm working outside. For the next 75 days, I'm going to buckle down. I'm going to change who I am and do what is best for my family. So I kind of buckled down, learned the industry, watched hundreds, if not thousands of hours of YouTube videos, read a couple books, got a couple of them over here. And I just decided that insurance in general is fun because you get to help people. You're truly helping people no matter who you sit with. But I liked the financial portion of retirement, seeing people misuse their money. Like, it's not a good thing, but finding people that are misusing their money and not really setting themselves up for retirement the way they should, I want to talk to those people. So I want to say it was January of 2022, whenever we went to Tennessee for DFL training, debt-free life training. Whenever I sat down for 2 days and learned debt-free life, I was like, there's no other option for me. This is what I want to do. It just makes sense. I'm a logical brain person, I'm good with numbers. So from that point forward, I literally spent every dollar that I had down to $300. I took out 2 loans, 2 EIDL loans. I told myself I'm gonna buckle down and I'm going full force into this. When I run out of money, I guess I'll go back to sewer camera business. Luckily, I got down to about $320. One day, my social media popped off, and I had 2 weeks of bookings every single hour on the hour for about 12 hours a day. The next day I woke up, I had a month of booking every single hour on the hour. So for one, I was like, okay, I have this great problem, but for two, I have to work every single hour for the next month. But long story short, got into the industry. I love math. I love to think compound and work for people to really change their outlook on retirement, because there's a lot of misconceptions out there, a lot. So I meet with people that make $100 million a year, and I meet with people that make $18,000 a year. So I see everyone, and most of them have the same knowledge of what they were taught in high school and the Dave Ramsey method. That's about it.
Yeah, I find it interesting because you were basically saying it goes the gamut, right? I mean, you're getting all these people who are millionaires, and then you're getting regular folk that want to talk to you as well. Since you brought that up, is there any kind of objections that you face when you're talking to the high net worth clients, like about if they have a financial planner?
You'd be surprised. I get less flack from high net worth than I do with low net worth. So someone who makes $2,000 a month will give me 100 times more questions and flags than someone who makes hundreds of thousands of dollars a month. Because the reason why is, if I haven't said yet, I have a lot of following on social media, and they watch 10, 20, 30, sometimes hundreds of my videos before they reach out. So basically, they're the subject matter expert. They've worked out all the kinks. They're just bringing their new questions that I haven't addressed yet. So basically, they come in and say, hey, I saw your video on tax-free retirement. I make $100,000 a month. How can I retire in 5 years? Like, that's how simple the conversation is. Versus whenever you're reaching out to people that don't know you, a lot of hoops. I'm sure you understand that, especially with lead systems, trying to coerce the high net worth community to sit with you, because like you said, everyone has their advisor, everyone has their CPA. But once you provide enough value, even if you do have some kind of stump, so the biggest stump I have is, I have had a CPA for 15 years and I say, okay, how do you like your tax bill? They freeze. I don't like it. Okay, maybe your CPA is not doing as well for you as you thought. If I could sit down with you and my CPA could show you some tax breaks, would that make sense? And they don't have to take over your book. They can just do a tax strategy with you. And if you decide to go with it, that's great. If you don't, that's great. Okay, yeah, let's put that on the books. And then whenever we end up saving them 30, 40, 70% of their taxes, I'm the new advisor.
So how do you approach that? Like, if you had someone, and of course you start with saving them taxes, and then what would be your next step with approaching someone who is that high net worth, earning lots of money a year? What would be your next step in helping them?
Most of the time, whenever I sit with someone that's surprise high net worth, like I said, whenever I sit with someone, I have no clue. They don't leave me a lot of information. The next person could be extremely poor. The next person could be a foreign country. They could be extremely rich. I don't know. So as soon as we do a quick fact finder, and I say, hey, judging by your net worth, judging by your income, and probably how much taxes you're paying, I feel like you should sit with the CPA first before we do anything. Because I could write you up this $2,000 a month index universal life. It'll do exactly what you want to do for you. It will. But if I can get you some tax savings, this policy can be free, and we can beef it up even more because your tax savings paid for it. So is that something that interests you? Oh yeah, great. And I'm just like, I'll be honest, I see about 10 people a day, about 50 to 60 people a week. I will forget this conversation tomorrow, so please bug me. And I think being honest, just telling them, hey, I have a lot going on. You are important to me, but I'm going to let someone take care of you for now. And then you can come back to me and kind of bring me a synopsis. And we'll go from there. That's kind of how I deal with it. It's a lot easier in my world because, like I said, they built rapport for me. I haven't built it. They went through my social media. They watch me. They say I'm consistent. I'm monotone. I just get to the point and I give you the information, and that's what they expect from me.
So how do you think that you've mostly been able to help people save for retirement? Like, what are your approaches with them as far as which direction you're going to go into?
Right. My entire book of business is off of future tax rates and tax rates now. So if I sit with someone who has $600,000 in a 401k and they think they're good, I say, hey, yeah, that's great. You get to live off 4% of that. It's not very much money. We back up and look at standard deductions. We look at Social Security, how much is going to be taxed. And then when they really see the big picture of, I'm going to have to pay the same amount of taxes in the future as I am now, it doesn't make a lot of sense. So let's back off contributions. Let's do Roth conversions. Let's look at something else that's tax-free. And if you know anything about tax-free accounts, there's really only two. There's the Roth and there's the cash value life insurance route. Now you can go the real estate route, but when you're in your 60s, a little late to do some cash out refinances and stuff like that. But basically, I sit down, I go over their entire portfolio, husband and wife if they're married, and we see what their future tax bracket's going to be. We don't even look at future tax brackets. Future tax brackets are going up 3% in 2026, and they're looking to double by 2035. And normally when I get to that point in the conversation, there's panic. There's panic in their eyes. So basically, my whole book of business is let's pay zero taxes, if any, and if we have to pay some kind of taxes, I have a CPA that can help you with it.
How do you advise people as far as getting Roth conversions? I've heard of
That's
that.
definitely, it is a formula. It's a self-created formula. You have to sit down. Let's say one tax bracket starts at 180,000, and your couple you're sitting with makes 120,000. Well, they now have $60,000 of room between this tax bracket and the next tax bracket, so they can technically roll out 60,000 of their 401k into a Roth and not jump up a tax bracket. So if we can do that over the next 3 years, you can technically roll $180,000 over to the Roth and not have to hit the next tax bracket. Now there's some kind of judgment. So between the 22 and the 24% tax bracket, that's the smallest jump. That small jump may make sense to go ahead and fill in the next $200,000 in Roth conversion. But from the 24% to the 32%, that's a big hit. We probably don't want to do that. Even though tax rates are going up in 2026 by 3%, because of the sunset laws, we definitely try to pay little taxes as possible to Roth convert to pay little taxes in the future, if any.
Got it. That is really cool. I've heard of that, so thank you for explaining the math behind that. That's good.
Yeah.
Good stuff.
Good learning. So what would you say your approach is? I'm sure that the age range goes from one extreme to the other. How can you best serve folks that are like under 55, and people in their 30s or whatever who have kids and they need to start planning? What's your best business model for that, for approaching them?
Basically, we just have to. Okay, let me backtrack. Whenever we have a family is, say, the husband and wife are in their 40s, they have 2 kids. I say the number one thing you probably need is honestly life insurance, because if you pass away in the next couple of years, the kids are stuck. What do they do? Your wife, she's stuck. What does she do? If your wife passes away and she's a stay-at-home mom, you have to come up with the meals, the transportation, the daycare. She means just as much financially as you do. So what we do most of the time is, let's say the husband has a $500,000 work policy. We'll say, okay, let's take it out on your wife. That way she has life insurance. And her insurability will be cheaper because she's a woman. Women are about 6 years behind a man in insurance costs. So basically we build a plan to say, if we start now, let's look at what 35 years of compound interest will do for you, tax-free. And then I back up and say, well, let's say that you say, no, I'm good, I'm going to go with my 401k. In 10 years, you call me back. We'll do the same amount of money for 10 years less and look at how you're going to have half as much income because you waited 10 years. And then I, of course, backtrack and say, I'm not trying to sell you anything. Simple math. This is what you could have. This is what you will have. And if you wait, this is what you could have. And most of the time, it sells itself. It's really just math. Albert Einstein said that compound interest is the 8th wonder of the world, because if you compound 1 penny every day for 30 days, most people don't know, it's $5.2 million. Kind of mind-blowing.
That is incredible. Now, you said the 401k. So what do you advise younger folks to do instead of a 401k?
I actually like the 401k for the match. And I always tell people, if you can get a 4% match, take it, because if you can get 100% ROI, that's like crypto. If I can put $50 into a crypto coin and the next day pull out 100, I won. So your 401k is basically that. The only problem is it's variable and it's taxable, but judging now, if you're 30 years old and we have 35 years of standard deduction growth, you can have about an $800,000 portfolio when a 30-year-old retires at 65 and not have to pay taxes. So we can actually build up close to $1 million portfolio in taxable income and still not have to pay taxes. So once again, I backtrack to, let's project your income off of a 401k match. Anything above that you want to contribute, tax-free, definitely. Now, a lot of people may not know the Roth is a great instrument, but there's limits. If you make more than $144,000 or you plan on it, so that's one thing I tell people. You may make $80,000 now, but do you plan on making $80,000 in 10 years? And I hope you say no, because if you're making more than $140,000, you just got to let your Roth sit to the side and let it grow. So would you rather start something now that you can completely either up your contributions or control for the rest of your life, or do you want to put your money in something that you may not be able to use in the future?
That makes a lot of sense. That's incredible. So so what you're saying is then, as long as their traditional 401k is still going to be non-taxable based on the standard deduction when they retire, then you still recommend they go ahead and take that match, do the traditional. They don't even have to do a Roth 401k. They can just do the traditional 401k and then count on that standard deduction, as long as they're not, don't have some above like $800,000, as long as they don't go above whatever the number is for them.
Right. Yeah. And then definitely if someone gives me a tax objection, I say, okay, let's look in the 70s. The highest tax bracket in the 70s was nearly 70%. The highest tax bracket in the 50s was 94%. So if you know anything about Ronald Reagan, he only worked until July every year, because every dollar he made after that, he brought home 3 cents. So you tell me, do you want to pay 97% possibly in the future because it's happened before, or do you want to backtrack and let's talk about tax-free?
Makes sense.
Got you. How about, curious, because I know, I'm sure Carissa does too, run into it as well, is when you're sitting with someone who says, oh no, they match 4%, but I'm doing 15%. Like, how do you run into that a lot? I mean, we know how we explain it to people that you're just putting that money at more risk. So how do you handle that? And have you run into that a lot?
Not very often. Most of the time, it's the lower net worth that maybe do. Say they get a 4% match, they do a 7%. So I say, okay, your 3% is an extra, let's just throw out a number, $500 pre-tax. If we take the taxes out of that, say 25%, we're looking at $375. If I can show you what $375 can do over the next 20 years, tax-free, and you get free life insurance, you don't have to pay for your term anymore, you don't have to pay for your whole life, would that make sense? We look at it, 100% of the time it makes sense. And then if they say, okay, I like the 7% because, it's just easier, I can control my 401k, it's with my employer, I trust them. I just say, okay, that 3% you're putting on top, no one's paying taxes but you. Your match, let's just say taxes go up to 50%, you put in 100, they put in 100, they're paying your future taxes, your growth is yours. But anything above that, you are on the line for 50% taxes. Now I'll tell you, most high net worth clients that I meet with, they max out their 401k just because they think that's the best. Most CPAs say, let's knock you down a tax bracket. You own a business, let's do $60,000 a year at 401k, that way we can drop you a tax bracket. Well, when we sit with the CPA and they say, that's fine, but if you would have done this, you could have only put away $12,000, paid zero taxes, and put $40,000 into an index universal life policy that you could retire 10 years early. So a lot of moving parts, a lot of knowledge has to be really built up to be able to work with high net worth clients. And really, they trust you once you can confuse them. I hate to say that, whenever you get a high net worth client and you blow their mind, they're like, wow, no one's ever done this for me. So we're definitely going to sit down again and talk about this.
Yeah, that part's incredible to me. I mean, it really is to know that it doesn't matter what your net worth is whatsoever. If you don't have the knowledge or no one's ever explained it to you, then you're blowing their mind, like you said. So what about if you had somebody who was very concerned about, what the future looks like for retirement, and now they're, 59 years old and they have 6 more years of work? What should they be doing?
Right, that's the toughest conversation, because most people, when you show them, hey, we have to make up for 32 years of retirement savings, so pretty much what we have to do is we have to backtrack all of that growth and shove it in now. Because once you have 10 years or less of planning, you pretty much get a dollar for dollar return. Meaning if you put away $24,000 a year for the next 6 years, you might get in return $24,000 a year of income, but it's for 30 years. So you're basically 3x your money. A lot of people don't see it that way. But if I backtrack and say, well, at your particular instance, if you were even to annuitize your 401k, which I never say to do that, you're only going to have, say, $20,000 a year of income. But if we backtrack and say, hey, you're putting $24,000 a year in your savings account, it doesn't make sense because it's earning you 0.06%. Rule of 72 says your money's going to double every 1,800 years. Are you going to live that long? No. Let's put that somewhere else, and let's get you $44,000 in income. So it's really just, I have to really not really hold someone's hand, but I have to show you all avenues so you understand that this is the only path you can take. 1, 2, or 3, which one is more beneficial for you? So I'll kind of say with an older person that's trying to play catch up, the only catch up account there is cash value life insurance. And I know this is an insurance podcast, but honestly, that is it. If you wanted to catch up with a 401k, $24,000 is all you get to put away. And I say all, that's tax deferred, so you have to pay taxes on it. With cash value life insurance, most of the time there is no ceiling. You can put away 110% of your income. So let's say that everything's paid off, your cars are paid off, your bills are paid off. Say you have a rental that's paying your taxes and everything, your gas, your bills, and you make $50,000 a year, you can put all $50,000 a year away into cash value life insurance and supercharge your retirement. So honestly, that's a hard pill to swallow, but when you've waited that long to retire, there's really only a couple routes you can go. It's a hard pill to swallow. Let's get it over with. Let's get it started. You wait a year, you're going to lose 20% in income. If you wait 2 years, you're going to lose 40%. So my whole book of business is zero taxes and logic.
So basically, if they're like that 58, 59 years old, as long as they're healthy enough to qualify, you would put them in a cash value life insurance policy, which I assume is an index universal life.
Yeah. So for whole life, I really only say let's do whole life if you have 6 figures or 7 figures to dump into something that you want to use for business or investing. Besides that, the whole life doesn't make a lot of sense because you can actually quote unquote pay up an index universal life policy just like you can whole life, but still gain massive cash value. So what I've done recently, we had a 60-year-old lady. She had no retirement. She wanted to retire in 7 years. So instead of putting away $22,000 a year in her name, she has 2 21-year-old twins. So we opened up 2 policies in the twins. Cost of insurance was way less. I get paid less. She gets more income. Worked out way better.
I love that. I love that because I'm dealing with a client right now in that same exact situation. I was like, oh, they have 2 young kids. 2 young teenagers. So we could do it that route. I love that. So basically the reason why is because the cost of insurance is so high, at that time, just for our listeners, the cost of insurance is higher at that time. So then she'll be able to save much more for her retirement at that point. Love it. It's beautiful.
And it gives people options. I've definitely sat with people who have medical issues, but they so desperately need to figure out what they're going to do. And so their kids have come into play so that it can help them out. It helps everybody. It's like a win-win type of deal.
Right. And
that's right.
What I always tell people is I'm an independent broker. I'm with over 20 carriers. And you know why? It's because with those carriers, each carrier has their upside. One carrier is great for multimillionaires. One carrier is great for a type 1 diabetic. One's good for a type 2 diabetic. That way, no matter what your problem is, we can probably get you covered some way, shape, or form. Then on top of that, we have the knowledge to work vertically, either with grandparents or kids. That way, if you're uninsurable, we can get you some kind of cash value.
This has been a really great conversation. One more question I have, Marcy, because I know we hadn't talked about the actual retiree, the one who is ready to retire. They can see the light at the end of the tunnel. They are there. So when you sit with them, besides saving them with their taxes, if they're high net worth individuals or have a business, what's your approach with them?
That's my favorite conversation because we always bring up the 4% rule. The 4% rule is out of date. If you look up new studies, it's really 3.1%.
Yeah.
So what I say is, hey, let's just be basic. You have $1 million in your 401k. If we still use the 4% rule, you get $40,000 of income. Standard deduction covers some of that, so you're really going to walk away with about $35,000. Now you have $1 million, but do you expect to live off $3,000 a month? Almost every time, no. So we say, okay, well, let's talk about a multi-year guaranteed annuity. If you can wait 1 year to date, we can get you about $55,000 a year of income. Of course, it's pre-tax because you saved up pre-tax. But that's more along the lines of about $48,000 of income. So that's a whole $1,000 more a month of income because you waited a year. So that makes sense. Yeah. Okay, well, if you plan to retire in 3 years, we can actually put you into a vehicle called a fixed indexed annuity. What that's going to do is it's going to mirror the market. You're going to get market-like returns and have a floor. So basically this year, the market went down 22%, you would just get credited zero. And since we're on a 2-year crediting strategy, not to confuse you, we're going to get more returns because we're letting the insurance company take more time to pay you. So with that being said, you could probably get about 10%. So that $1 million, if you wait 3 years, might get you about $105,000 a year of income. Now, would you like to triple the 4% rule, or would you like to stay with the 4%? And if they say, well, my financial advisor says annuities are junk, say, okay, what did they tell you about it? Most of the time they go blank. Say, okay, what most financial advisors hear when you say annuity is annuitization. That's what they're taught. You put money into something, the insurance company keeps it, they give you a little bit of interest for the cost of living adjustment, and that's it. That's not what we're talking about. We're talking about a multi-year guaranteed annuity with a death benefit. So if you put $1 million into your multi-year guaranteed, you take it off the top, $55,000 for the rest of your life. When you die, $1 million is left to your family. With fixed indexed annuities, we try to take 10% because on average we earn about 11% in some of these indexes. So meanwhile, you're taking 10% and your account's actually growing. So if you live 30 years, you might leave $1.5 million behind, and you took more income. So you tell me, let's backtrack. $31,000 a year, $55,000 a year, or $100,000 a year. Which one makes more sense to you?
No brainer.
No brainer. All right, I have 2 questions remaining, sir. The first one is, what about educating, especially older folks, to understand about living benefits and how they play into, well, obviously IULs, right? I'm not talking about older people, but I'm just saying a lot of times people don't realize the value, and then also with annuities that they have access to money to use if they needed it. Do you find like people already know this, or that you're educating them and they're like, wow, you just blew my mind?
What I like to do is if I'm in that conversation with someone 40 or older and they start to give me a little hesitation, I say, oh, well, did you know, because I forgot to bring this up, long-term care right now costs about $4,000 a month. So can you chill out $50,000 if something happens to you? Well, the average long-term care stay is 2.1 years. So does your family have $100,000 laying around that they can pay for this, or are they going to have to liquidate your estate, get rid of your house? You've heard all the nightmare stories about it. Is that something you want to go through? No. Oh, well, by the way, this has a long-term care rider. Something happens to you, you can't do 2 of the 6 ADLs. We can actually get you up to 100% of your face value paid out immediately. That way that $100,000 doesn't come out of your estate, it comes out of your life insurance.
Right.
Incredible.
Okay, what's your favorite book that you would recommend to people for the? Okay.
He's ready.
Right.
No and tell.
So I got anything David McKnight. This is Tax-Free Income for Life. This is like the
I'm listening to that now.
Right. This is the second book in the series. The first one is Power of Zero. Power of Zero blows your mind. This is how you implement it. The Laser Fund, if you want to know about an IUL, this is literally the best book you can find, because one side is actually going to tell you about it, and the other side is going to tell you real life stories of how people used it.
Wow, the Laser book. I never heard of that.
Me neither. That'll be my next book to read.
It's called The Laser Fund by Doug Andrews.
Doug Andrews. Awesome. I see him on Instagram all the time.
Yep. I've watched probably every video he's ever uploaded on YouTube. And if you know anything about his videos, they're 20 minutes long, and he has about 600 of them.
I should probably start the process of watching all of them as well.
Yeah, 600.
We
can know as much as you do.
Right. You just put your phone down, and if you have YouTube Plus or whatever it is, Red, I don't pay for that. But if you just want to set it down and listen to it, I did that for a long time.
Awesome. Love it. Well, I don't know about you, Marcy, but I've learned a lot. I hope you, our audience, have learned a lot. And, we're going to have a lot more of these kind of conversations. And Dustin, we are so grateful for you dropping so much knowledge, dropping so much golden nuggets on us today. This has been so good. And hopefully we can have you back again soon.
You bet.
To share more. Love it. Well, thank you so much for joining us, everyone, today. Thank you again, Dustin. Appreciate you. And we will see you next time.
All right.